TD Bank said, oh yeah, tell all their people silver's going to $40.
Now, what do you think about Michael Oliver's prediction that silver could hit $250 before July?
He's a very, 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 very smart man. Everyone wins. If you let the price go higher, you have to in order to find silver here. It's disappearing, it's depleting, and it's found near the surface. The big deposits were found forever ago. And if that weren't true, then why would it only be under 20% of all the silver that came to market last year, of which it's going to be another 200 million ounce shortfall again? Why would it only 20% come from companies mining it? The rest is byproduct.
With such a premium in the East, why is there any silver left in London or New York? Is this part of the big plan?
I don't know how much of it is flown over there, to be honest with you.
Andy, why now with the COMEX lower margin requirements?
Because there's no open interest. Everyone got fleeced and they have no one to fleece. At some point, no one wants to play that game anymore. Now you have record low open interest in terms of managed money. They're trying to lure the managed money back into the game.
If you think it's going to go to 250, don't say anything. There's your answer.
What did we see when silver, that week when silver, right before silver fell, TD Bank said, oh yeah, tell all their people silver's going to $40.
That was a quick short.
Yeah, and they got stopped out at 92. Yeah. Well, it's the banks in Canada and the banks in Europe that have the massive shorts. And if the economic times is right, then the commitment of traders largely validates this. They're not completely long. They're more long than short. Anyways, the way that it works is, I believed, at least to get the majority of it here to begin with, it was the threat of tariffs. And even though they really never materialized, that's what it was that I think enabled the banks to get the majority of their metal home in a very quick period of time.
Very well said. John, do you have that last one up? It kind of struck a nerve.
Oh, what did it do?
No, I just thought it was somewhat silly.
Where is it?
I don't know.
Yeah.
It was the one with...
Oh, I list it.
Oh, it was, so then it must not have been. If you can find it, it was something about you should only put in bullion excess cash or something like that. It was kind of one, but that's you look for that while I get a couple more up here. Here we go. Keith Nystrom. With the shift to 60-20-20, and I think they're talking about the allocation model, do you think that gold, silver capital gains tax will be changed to the same as stocks? Look, I think it's the absolute most ludicrous thing in the world that they consider gold and silver, all metals, a collectible, and that you should be paying more capital gains tax than on any other investment.
The real story isn't the $40 forecast. It's who was positioned to benefit if it failed. As Andy Schectman points out here, Canadian and European banks held massive shorts that triggered the $92 stopout, showing institutional influence far outweighs retail predictions. Traders' long positions appear validated only superficially, masking rapid accumulation strategies enabled by tariff fears that never materialized. The underlying risk for investors is that paper positions can distort pricing far faster than supply-demand fundamentals suggest. Next, Andy Schectman discusses how allocation models and tax treatment continue to shape market behavior.
To be even more ridiculous, they expect you to pay more capital gains on something that you have made money back on because the fiat currency that you're holding has depreciated 99% in the last 113 years.
Did you know they put that same collectible capital gains rate on GLD and SO too?
I know. To me, it's an absolute, it's a laughing stock of the tax law. I truly believe that it is absolutely unconscionable that that's the case, that they want you to pay an additional up to 8% greater on any and all these metals, which are not collectible. We're not talking about pre-33s here. And that it's going to be for you, the buyer, to increase your purchasing power to make up for the loss of value that you've held in your fiat. I think it's absurd. So yeah, I certainly hope so. I mean, look, the Sound Money Initiative out there has been doing great jobs and great things with advocating for no sales tax on
That's what happened
metals.
with the Florida.
That's right.
Just passed.
And I think the
Both
more
House and Senate.
that's right. I think the more that the states push in for the sales tax, I think is going to be the lead foot of getting the federal cap gains tax, if not abolished, which I doubt that that's going to be, but at least lowered or reduced to the standard capital gains tax on long-term capital.
Well, that's why they're allowed, the states like Florida and Texas are saying when you use the gold and silver for legal tender purposes, probably in the form of a digital app, when
Right.
it's fully mature, there'll be no sales tax
Correct.
on whatever you buy.
Correct.
The hidden risk isn't just higher taxes. It's how lawmakers treat fiat erosion versus tangible assets. As Andy Schectman points out here, the 99% depreciation of the dollar over 113 years makes a collectible capital gains rate on metals absurd, artificially punishing investors for preserving wealth. State-level actions like Florida's no sales tax legislation signal cracks in federal policy, but federal reform remains uncertain, leaving portfolios exposed. For long-term holders, this disconnect could erode returns if ignored. Next, Andy Schectman unravels how state initiatives may influence broader capital gains policy.
So that's the got this one. How much longer can the paper market control? Andy, why now with the COMEX lower margin requirements?
Because there's no open interest. Everyone got fleeced and
That's it.
they have no one to fleece. So
It's amazing what happens when you lose all your business and then how you have to try and derive new business.
right, well, the open interest is like, I go in there, the price goes up, they jack up rates so much I get screwed. At some point, no one wants to play that game anymore. And so right now you have record low open interest in terms of, the managed money is they're trying to lure the managed money back into the game.
Yeah.
Rinse, wash, and repeat.
That's it. And then, of course, once they start seeing the contracts in full swing, what are they going to do?
Raise margins.
Raise margin requirements. That's it.
And then you get to a point where the COMEX just ceases to have any credibility.
That's it. Yeah. I don't want to do that one. That's a little bit more politics than we care to get into right now. No, again, I'm not going to do that. PJ Bowler says, tattoo, if you ever feel aggravated first thing in the morning, remember, just stop and breathe and clear the mind. Always make 30 seconds for yourself. I appreciate that, PJ Bowler. I will remember that tomorrow morning when I take my right leg, step off my bed.
30 seconds for yourself.
I'm not going to get up yet. I'm going to take 30 seconds.
What if your wife yells at you in those 30
She won't,
seconds?
because she's going to be sleeping.
You son of a...
No, she'll be sound asleep. She doesn't get up. But so when my client said, "What the hell were you doing up?" I said, "I didn't get up. My prostate did."
Yeah, exactly.
That's funny. Mine too.
Margin cuts rarely signal relief. They expose desperation. As Andy Schectman points out here, record low COMEX open interest shows managed money has fled, and any attempt to lure it back inflates systemic risk. When rates are jacked and contracts oversold, credibility erodes, leaving small investors exposed to structural gaps the media ignores. Behavioral quirks, like taking personal advice from PJ Bowler, highlight the human side of these volatility swings. Next, Andy Schectman discusses why COMEX credibility matters more than daily price moves.
I said, that's the reason I'm up. But thank you, PJ. I do appreciate the words. Does this make Russian... What? It's not real. Rita, does this make Russian oil more valuable?
Does what make Russian?
I guess the war that we're talking about, does it make oil more valuable?
Well, I guess. Oil is oil.
Yeah,
right?
I mean, anything's going to be more attractive when you're talking about war. And
It's
they
just
cut
that they're
supplies
kicked out
off.
of the
Right.
the market, but they've been selling oil anyway all around the globe
Yeah.
to countries, regardless of the sanctions.
Yeah. Anthony Lux, 1838. Question, Andy and Kevin. Do you really think the government and their buddies in tech, war, and other sectors would allow mining companies, not their buddies, to flourish at their expense? 300 plus.
Someone sent me that question exactly last night, and I replied to him. Probably was. I think they will. I mean, everyone wins. If you let the price go higher, you have to, in order to find silver here. I mean, it's disappearing, it's depleting, and it's found near the surface. The big deposits were found forever ago. And if that weren't true, then why would it only be under 20% of all the silver that came to market last year, of which it's going to be another 200 million ounce shortfall again? Why would it only 20% come from companies mining it? The rest is byproduct.
Headlines suggest scarcity drives value, but production realities tell another story. As Andy Schectman points out here, only 20% of last year's silver came from active mining, leaving a 200 million ounce shortfall. Yet media narratives ignore byproduct contributions. Sanctions on Russian oil create hype, but not fundamental supply changes, skewing perception of commodity leverage. Investors must differentiate scarcity from narrative, considering extraction difficulty and regulatory influences. Next, Andy Schectman shows how production shortfalls mask broader market vulnerabilities.
You have to dig further, go look harder, spend more money, expend more energy to get it. It has to be a price level that incentivizes domestic mining. So yes, I think they will. And besides, it's a globalized commodity where, again, what's it really worth when the whole world is moving away from perhaps the Western price setting because of all of these shenanigans and the loss of trust? What's it really worth? Yes, I think they have no choice. And again, because it is inelastic, it's a little bit that you need for a big priced item, like in anything, silver and an iPhone.
Yeah.
$5, $6, $7 worth for $1,100. So if it tripled, so now it's $21 worth. So it goes to 11 to 11 and a quarter. Big deal. They will
They're paying it.
They will pay it and they will accumulate it. And yes, I do think they will go higher, and I think it will come to a point where managing it becomes next to impossible.
This is now going to be, is this going to be the 6th or 7th year
6 for sure, maybe 7
of a supply glut? And I think that we're talking now, we are almost in aggregate a full years of mining.
Yeah.
Silver is what we're looking at right now.
Even more than that.
And it's going to be getting
It's
greater
way
than
more than that.
Yeah.
They only mine 850 million ounces a year or so. So
And
we're
our
already
total
over a
shortfall,
billion.
yeah.
Way over.
So, yeah. We did that one already. You gotta love this one. Eugene Levy and Walter Matthau show. I don't know, my eyebrows, are they that thick? Wow.
Most investors miss that the perceived silver glut masks deeper scarcity and extraction limits. As Andy Schectman points out here, only 850 million ounces are mined annually, yet cumulative supply already exceeds a full year's output, highlighting how inelastic demand can drive accumulation at rising prices. Global price setting is fragmenting, meaning Western benchmarks may no longer dictate true market value. This suggests portfolio strategies relying on traditional supply-demand narratives could be blindsided. Next, Andy Schectman discusses why managing supply and price pressures will become increasingly complex for investors.
Eugene Levy. I mean, Walter Matthau, yeah. But Eugene Levy? I mean, I think I'm a little offended.
Gene from now on.
I should have not read that one.
He's funny.
Yeah.
He died.
Lee Fury, what do you see in the future of the gold-silver ratio? I mean, look, it's a very difficult question to answer.
You should try.
I definitely think that it's not going to be 65. I think that if we look now, and I think that when we look back and we look at the historical average, which is, depending on which statistics you look at, somewhere between 40 and 45. I think that also for a good number of years did not take into account the utility that silver now provides that it did 45 years ago or even 20 years ago. So the utility now is far, far greater and has a much greater reach in technology and solar, in so many different industries. And many of those industries are growing extremely fast. So I would say that I believe that near-term average that I look at is probably going to be somewhere in the neighborhood of around 30 is what I'm looking at. I think that's a fair
It
estimate.
was 16 to 1 for 5,000 years.
Right. Yeah. And
Headlines often ignore how industrial utility reshapes asset ratios. As Andy Schectman points out here, the gold-silver ratio historically averaged 40 to 45, but today's technological and solar demand suggests a near-term average closer to 30, undercutting assumptions based purely on historic ratios. Investors who anchor to outdated numbers may miscalculate allocation in metals portfolios. Rapidly expanding industrial uses indicate structural demand pressures that dwarf traditional hedging arguments. Next, Andy Schectman shows why ignoring industrial silver utility risks mispricing your exposure.
and we weren't using it for nearly what we use it now for. And it was a lot easier to garner then than it is now. That's for sure. All right, let's go on. Andy, this is from Russell Stover. Love those chocolates. We used to sell those a lot in like elementary school, Russell Stovers. Did you do that?
No.
You did that?
No.
Didn't have that in Minnesota? You didn't sell chocolate
Did
and
we?
books?
Well, for baseball, we had to sell like stuff, but
Like baseballs?
if it was chocolate, I would have ended up probably eating it
Well,
all.
that's what we did. I mean, especially those chocolate covered cherries.
When Joey Sigil would come to us with the big bags of salt.
Salt?
So
Yeah,
He would sell you salt?
Yeah.
can't eat salt.
I definitely can't eat salt.
Big
What the hell
bag.
to buy it for?
For your water salt.
Oh, yeah, that's not nearly as fun as chocolate or books. Well, in any case, Russell Silver wants to know, Andy, with such a premium in the East, why is there any silver left in London or New York? Is this part of the big plan?
Well, I mean, I don't know. It's interesting. We don't know how much of it. I don't know how much of it has flown over there, to be honest with you.
And realistically, I mean, with 80 million ounces in COMEX is not really a lot at all.
Supply narratives often hide geographic arbitrage. As Andy Schectman points out here, 80 million ounces on COMEX may seem significant, but in global terms, it's minimal, highlighting how premiums in the East can draw metal away without affecting headline numbers in London or New York. Investors need to recognize that physical flows, not just paper positions, dictate availability and risk exposure. Next, Andy Schectman discusses how eastward movement of silver reshapes perceived liquidity in major exchanges.
But the fact that it's still staying on is telling you that it's still being shipped over there. So enough. And it's, it's not easy to do. You would have to do an exchange for physical to Hong Kong, where there is a Brinks contract there, and they would truck it over to Shanghai. Would be the way that I would think it would be done.
I'm only putting this question up because I know that you...
Maybe that's why they have trading desks over there in Singapore.
Singapore
Yeah.
for JP Morgan.
Yeah.
Yeah, that's they're moving their trading desk, supposedly.
Yeah.
I'm going to put this up only because I know that you're not going to say anything about it. But what do you think about Michael Oliver's prediction that silver could hit $250 before July?
Well, he's a very, 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 very smart man. He's the only one I know who does momentum analysis. He's got more courage than I do.
I happen to love Michael Oliver, and I think he's extremely well-informed, very intelligent. And I think that anything is possible. I truly do. I mean, I think that we are probably one event away from something causing an absolute
He's back.
effect. Hey.
She won't leave me alone, so let's bring her up.
Cutie. Yeah, it's very possible. Look, anything is possible. I don't put it past it. But remember, in order for us to get to 250, we first have to get back to 100. So let's let it ride.
Price targets often ignore logistical friction in real-world delivery. As Andy Schectman points out here, moving silver from Hong Kong to Shanghai requires complex exchanges and trucking, meaning that theoretical momentum plays like Oliver's $250 target are far from guaranteed. Physical constraints, trading desk relocations, and supply bottlenecks create hidden risks that markets often overlook. Investors must distinguish potential from practical execution to avoid mispricing. Next, Andy Schectman talks about why operational realities can limit even the most aggressive silver forecasts.
Yeah. No.
No, doesn't want to take that one.
If you think it's going to go to 250, don't say anything. There's your answer. Perfect. All right. That's what me. All right. Next one. This is. I think you always answer this one. What silver mines would you recommend to invest in? Copper too.
Copper, Freeport,
Mac
McMoran, silver, First Majestic.
Always.
I always forget. It's my biggest.
Do you think
holding.
Keith Neumeyer's getting new shirts made?
I don't know.
Getting ready to make
He should.
4-digit silver?
He should.
I think it's getting there.
Yeah, it's what is my? I never remember it's my biggest holding, and I can never.
You say that every single
I always, it's like a brain lock for me.
I should know it then by now. Say all that off.
I like. Just keep talking, and I'll come to me.
We'll go to the next one. You'll get it.
It is.
You'll get it. You'll get it.
My biggest holding.
Stephen Yetman says there is a delivery delay out of Mexico, and this is squeezing the price. Folks, read the newspapers, please. Yeah, I mean, look, that's certainly one of the cases. There's delays all over. You find it yet?
No.
Okay, we'll keep going.
Hang on.
Oh, Daniel isn't real. Wants to
Pan
know.
American Silver is my biggest holding.
Pan American.
First Majestic and Pan American would be the two that I personally own. Dolly Varden is exploratory. I do own it, but that's not what I would really consider to be a silver producer. They're not producing, to my knowledge. But I also like the royalty stocks, and it used to be called Silver Wheaton. I think they changed the name to Wheaton Precious Metals. I like that a lot as well.
Mining recommendations often obscure production realities. As Andy Schectman points out here, delivery delays in Mexico and the limited output from companies like Valley Garden demonstrate that not all holdings labeled silver producers contribute meaningful supply. First Majestic, American Silver, and Panama American remain core positions, while royalty stocks provide leveraged exposure without production risk. Investors should recognize these nuances when allocating capital to metals equities.